Inflation is falling, but spending is rising. Hey, it's Eric Ossis here with ericismybanker.com and CMG Home Loans with my weekly update on mortgage rates for the week ending, or actually starting August 15, 2023. Running a little bit late for my report this week. I was offshore outside of Nia Bay doing some fishing for an extended weekend. Learn more about that by clicking on my YouTube channel. Lots of cool videos for that. Well, the bond market has been sharply focused on inflation. I talk about that all the time. Good inflation numbers increase the odds that the Fed will stop its economy stifling rate hikes. The only problem is we're not seeing enough stifling. Last week brought good news with July's CPI, the Consumer Price Index, numbers increasing only 0.2% against forecasts of 0.4%. That was 3.2% annually. Mortgage rates responded positively until San Francisco Federal Reserve President Mary Daly stated the Fed has more work to do regarding inflation, igniting a decisively negative tone in the markets. This week so far, we got retail sales for July. They came in hot, up 0.7% against estimates of 0.4%. That was a surprise indication that the economy is not slowing as the Fed would prefer. It seems that consumers are out there buying things and taking vacations despite inflation. Why such strong spending? Could it be post-COVID demand, or that workers' wages increased over the past year, which they have? Or is it the wealth effect felt by many because their 401k accounts have fattened here over the last several months? Regardless, good economic news is not great news for lower mortgage rates. So far this week, mortgage rates are higher, nearing a 52-week high point. Here are the national averages. Conventional 30-year fixed rate, 7.26%. That's up 0.22 from a week ago. 15-year fixed rate, 6.65%. That's up 0.25 from a week ago. FHA and VA 30-year fixed rate, 6.96%. That's up 0.26 from a week ago. 30-year fixed rate jumbo, 7.25%. That's up 0.12 from a week ago. Moving on. Credit card debt surpassed $1 trillion. As of June 30th, Americans' credit card debt levels surpassed $1 trillion for the first time ever, according to the New York Federal Reserve Bank. If you add in auto loan balances, household debt levels are up to $17.06 trillion. How much is a trillion? Here's a visual. The average interest rate, this is even worse, on a credit card is a whopping 21%. On a $10,000 credit card balance, that's $175 a month just for the interest alone. I know what you're thinking. Eric's going to talk about cash out refinances now, or HELOCs. Well, you're right, but something needs to be done. So let's look at a two-step approach. Step one, consolidate those consumer debts into a lower interest rate and lower monthly payment using a cash out refinance. But not just any cash out refinance. Let's use our all-in-one account where you can cut the length of a 30-year mortgage by years, saving tons of interest. Step two, optional, but wait for inflation to bottom out and watch for an opportunity to refinance using to an even lower interest rate using our rate rebound program, which waives all lender fees and gives a $1,000 credit towards title and escrow fees. That program lasts until the end of the year, but you have up to 5 years to take advantage of it. The bottom line is that eliminating high interest rate debt is good to your overall financial health. You can use some smart financial tools to do just that and have your mortgage paid off in record time. Give me a call and we can look at your personal financial situation and set up a plan to maximize your financial health. You can call me 206-915-3742. You can email me, eric@ericismybanker.com, or look for me on social media. Just look for Eric is my banker and you'll find me. And be sure to subscribe to my YouTube channel so you get these updates every week. That's all I've got for you so far this week. I hope you have a great rest of your week. Talk to you next week.